Managing your money the right way is tricky, but it becomes even trickier in a recession. Managing your money is like managing a baby. If you want your baby to grow big and strong, you need to nurture it, feed it to help it grow, and help guide it. Okay, Andy, I need you to be big and strong like your brother Benji. Just make sure you don't kiss your dollars the way you do your babies because, well, that's gross. Nurturing your money, guiding your money, and growing your money is very important. But it becomes even more important when you're in an economic slowdown or a recession. Lucky for you, we're gonna be talking about how to manage your money the right way during a recession, so make sure you watch this video until the end. Managing your money comes down to 3 things that I call keys. And these aren't just regular keys, these are major keys. Key number 1, spend less money. Key number 2, earn more money. And key number 3, invest like crazy. If you can master these 3 money keys, you will be financially successful. It's not rocket science. I mean, it's financial education. But it's a lot easier said than done. I mean, if it was easy, then the majority of Americans wouldn't be broke, with no savings, no investments, and drowning in debt. Yeah, the first thing you need to do, especially during a recession, is get your cash in order. Oh yeah, I'll keep my cash in order, keep the big bills on the outside. Not that kind of order. If you have no savings during a good economy, you are at financial risk. And if you have no savings during a recession or an economic slowdown, well, now your financial risk is 10 times bigger. I don't care if you make $50,000 a year or $500,000 a year. You need to put some extra cash aside right now. That way, if you lose your job or if your business slows down, you don't have to run over to your bank and get some emergency cash through a loan. That means you might need to hold off on some things like extra guac until you have the savings cushion built. Wait, but Jaspreet, my cousin Bunty told me that guac is good for your soul. Your cousin Bunty is right. But he's also broke. Saving your money isn't the funnest thing to do, but you need to have a savings cushion. Once you have that, now it's time to grow your money. From now on, when you hear the word recession or you hear the words economic slowdown, I want you to think of the word sale. Gucci's going on sale? No. When the majority of people hear the word sale, they think, oh, what more clothes can I buy that I can't afford? I want you to start thinking different than the majority of people and start thinking like the minority of people. When you hear the word recession, I want you to think investment sale. More millionaires are made during recessions than any other time because recessions mean opportunity for the minority of people who think different. When a recession happens, great investments go on sale, and that means you can come in and buy up these really good investments at a huge discount, which means you can build your wealth a whole lot faster than you would be able to normally. We've seen it happen time and time again with the 2008 crash, the 2001 dot-com crash, the 1990s crash, and the 1980s crash. Every single one of these times, people come in who have that minority mindset and they get to buy up investments for dirt cheap, and they're able to build their wealth so much faster. History has shown us that over the long run, strong companies, the economy, and the stock market all go up. And like Warren Buffett says, never bet against America. Now, let me also give you this disclaimer. Investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So do your own due diligence and don't blindly listen to a random guy on YouTube. During the 2008 crash, stocks were selling for 50 to 60% off retail price, and real estate were selling for up to 80% off retail price depending on where you live. This creates opportunity because now you can come in and you can find good investments and you can buy up more investments with whatever cash you have. The simplest way to do this, especially if you are a newer investor, is to create a financial system. That way each and every month you're allocating a little bit of money to your investments. One way you can do that is by following our 75-15-10 plan or our 50-30-20 plan. Our 50-30-20 plan is for people who have financial responsibilities and have people relying on them financially, and our 75-15-10 plan is for people who don't. What these plans say is that for every dollar you earn, 75 cents or 50 cents is the maximum you can spend, depending on which plan you follow. 15 cents or 30 cents is the minimum you should be investing, and 10 cents or 20 cents is the minimum you should be saving. You're going to do this for every single dollar you earn from here on out. Now, you have a plan for your money and you're guiding your money and telling it where to go, almost like a money baby. Aww. The most accessible place for you to invest your money is the stock market. But just because it's accessible doesn't mean it's easy. And the last thing you want to do is just blindly throw your money into the market. Thing about economic recessions and crashes is not every business makes it out alive. I mean, we've already seen bankruptcies in the energy space, the retail space, the travel space, and you can expect that we'll see more bankruptcies as time goes on. The last thing you want to do is just throw your money into a company thinking, man, this company is going to get rich because it's so cheap right now, and then you find out this company goes under and you just lost all your investments. That's why you want to do your own due diligence and not just blindly listen to a random guy on YouTube. Did you just say random guy on YouTube? If you don't know how to analyze a company or research a company, then you might want to consider investing in an index fund. You can think of an index fund kind of like a big group of stocks. Some of the more popular index funds are SPY, SPY, and VOO. Now, I'm not telling you what to invest in, just an example, but both of these index funds are comprised of the top 500 companies in the United States. So if you invest in those funds, you get exposure to all 500 of those companies. Now, if one of the companies in that fund goes bankrupt, you're still okay because, well, there's 499 other companies in the fund. This is probably one of the easiest ways to invest in the stock market because now you are literally just investing in the stock market, and if the stock market goes up, your investment will probably go up. The stock market comes down, your investment will probably come down too. The keys to being a successful investor are to 1, make a good investment, and 2, which is just as important, is to be patient. If you're looking for a way to get rich in 30 days, then you're following the wrong channel. And anybody who tells you otherwise and tells you that investing is a way for you to get rich quick, well, then they are trying to sell you something. If you don't want to invest in stocks, then you can look into investing in real estate, and real estate is actually my favorite place to invest my money. When you invest in real estate, you own a tangible asset, a property, and then you get passive income from rent from the property. The downfall with real estate is it takes a lot more physical work to get started because you can't just buy up a bunch of properties through a click of a button, and it costs more money to get started. But remember what we said before, recessions are times where investments go on sale. But if you're sitting there thinking that real estate prices are just going to suddenly get cut in half, you're going to be really disappointed. Real estate prices don't fluctuate as fast or as much as stock market prices because it takes a lot more time for a real estate transaction to be done, versus you can buy or sell a stock in a second. So while you can see the stock market drop 30% in just a couple weeks, it takes real estate generally a whole lot longer to come down in price. What we do know, practically speaking, is that if unemployment is high and the economy is slow, people are not going to want to go out and start buying their dream house. That means you'll have less buyers for real estate out there, and now if somebody owns a home and they want to sell it, well, now they're going to have to lower the selling price of their property to attract more buyers into their property because, well, if their price isn't low enough, then a buyer is going to go somewhere else because now there are more sellers than buyers. This is called a buyer's market because buyers have the advantage since there are more sellers than buyers in the market. For the better part of the last decade, we've been in more of a seller's market where there are a whole lot more buyers than sellers, and so sellers had the advantage because buyers would compete against each other to buy a home, and in order to compete, buyers would have to raise the amount of money they'd be willing to pay to buy a home. Obviously, there's a ton of uncertainty out there, but we need to pay attention to the amount of demand for real estate because if the demand starts to fall, you're going to see the price start to fall too, and I'll be keeping you updated on our YouTube channel, so if you haven't subscribed yet, make sure you do that. So now we talked about key number 1, spending less money, and key number 3, investing like crazy. But what about key number 2? Earning more money. I like to save key number 3, earning more money, for last because once you understand that you will get the most bang for your buck and the most value when you spend less money on extra guac and more money on buying Chipotle, that's when earning more money will give you the most power. Can I still get some extra guac though? Remember that financial system we talked about just a minute ago with the 50-30-20 plan and the 75-15-10 plan? Well, if you really want to explode your wealth game, you need to add some fuel to the fire, and in this case, it's adding more money into your funnel. You could try to work harder at your job, but when you're in a recession, it's not always that easy. But even if you're like most people and you're working in an industry that's being hurt by this economic slowdown, that doesn't mean that you can't make money outside of your job. This crisis has taught us a lot of things, but one thing that it has showed us financially is that the internet is the future. Traditional brick and mortar stores were hurt more than anything else because they had no way to operate, and it pushed everybody to do business and do things on their laptop and their phones. Lucky for you, you can start a business right off of the internet. If you don't believe me, just look at me. Minority Mindset is a completely digital financial news and financial education company. Plus, do you know what Airbnb, Hershey, Instagram, Uber, WhatsApp, and Disney all have in common? They all make a lot of money? No, yeah, but they were all founded during a recession. Every crisis comes with opportunity for the minority of people who think different. And so now, when we're faced with this economic slowdown, you can either sit there and complain about it, or you can do something to capitalize on it. It is more accessible now than ever, and you have so many free resources literally on your fingertips. With all these job losses, a crazy stock market, and an uncertain economy, do you know how to manage your 401k right now? You have been working hard at your job, investing a little bit of your paycheck into your 401k each and every month, and for the last few years, things have been going great, and you could picture yourself dancing on a beach during retirement. Now, with all this economic uncertainty, it feels like your retirement dreams just got shattered. No! This pandemic came out of nowhere, and it was the needle that helped destroy the economy, it hurt the stock market, and it is slashing 401k accounts. So what do? Sell everything? No. If you have a 401k, you need to know how to manage it the right way right now, because if you don't, your investments are going to pay the price and your golden years of retirement might not look so golden. Just so we're all on the same page, your 401k is a tax-deferred retirement account. When you invest your money into your 401k, hopefully your employer will give you a match, but then your money gets to grow tax-free. Then, when you're old enough, you can pull your money out of your 401k and you can enjoy the wealth you worked so hard to build. When an economic crisis happens, the last thing you want to do is turn your retirement account into a day trading account and start panic selling everything like many people did with their 401k accounts when the stock market crashed. Your 401k is a long-term investment account. It is not a trading account, so make sure you treat it like that. Well, what you want to understand is how you can find the opportunity in this crisis, especially when it comes to your 401k. There are essentially 5 things you want to pay attention to when it comes to your 401k right now, and I'm going to go over all 5 of these things. They are your 401k changes, taxes, your company match, fees, and asset allocations. That way you can get the best return on your money. Let's start with some 401k changes because of this crisis. If you are facing a financial hardship, the United States government passed a bill that says that you can pull out up to $100,000 from your 401k early without paying a 10% fee. This way you can use your money to help with your financial hardship. Wait, are you telling me I can cash out Jaspreet without paying a fee? Well, it's not exactly a free way to get your money out of your 401k. You have to pay this money back to your 401k that you pulled out within 3 years, and you also have to pay taxes on the money you pull out, and you have the option to pay these taxes over the next 3 years too. So this isn't really a way for you to just access your 401k money, but if you are facing a real financial hardship, this is something you might want to consider. Second, let's talk about taxes. Taxes. Now, I do need to tell you that although I am a licensed attorney, I am not your attorney, so if you have specific legal questions, talk to a tax professional in your area. The way taxes work in a traditional 401k is you make money today and you get to invest this money into your 401k without paying any taxes, and then your money gets to grow tax-free, and then when you're old enough, which right now is 59 and a half years old, you can pull your money out and your profits out of your 401k, and then you'll pay taxes at the end when you pull your money out. The alternative is a Roth 401k, which is where you make money and then you pay taxes on the money you make today, and then you take these after-tax dollars and you invest it into your Roth 401k. Now your money gets to grow tax-free, and then when you're old enough, you can pull all this money out of your Roth 401k without paying any taxes because you paid your taxes on the front end. This concept is more important to understand now than ever because in 2020, the United States still has historically low tax rates. But at the same time, the United States is also racking up debt faster than we have ever seen in history. I can't predict the future, but what that tells me is that there's a higher possibility for our taxes to go up at some point in the future when it comes time for you to retire to help pay for all this expensive government spending. Of course, we don't know when that would be or how drastically our taxes would go up, if any, but if you have the option to invest into a Roth 401k, you can protect yourself against this uncertainty by paying taxes today when tax rates are historically low, instead of potentially paying a much higher tax rate in the future. Third, let's talk about your company match. If your company is seeing financial difficulties, like many companies in the world are, then there's a chance that they might cut your 401k investment match, like some companies have already done. If your company cuts your 401k match, that does not mean that you should stop investing your money. That means that you need to decide if you want to keep investing money into your 401k or if it's better for you to invest your money into your personal investment account or your IRA, depending on what your goals are. But I'm going to save IRAs for a different video, so if you haven't subscribed yet, make sure you do that. Listen, recessions and economic slowdowns are the worst time to stop investing. This is the time where you want to double down on your investments and buy as much as possible, because now investments go on sale and you have the opportunity to buy great investments at a huge discount. Now, of course, investing has risks. You are never guaranteed to make money when you invest. You might even lose money when you invest, which is why you should always do your own due diligence. That way you're investing in strong companies and funds, and that's why you should never just blindly listen to a random guy on YouTube. But what you have to remember here is that if you invest your money in your 401k, you can't touch your money until you're almost 60 years old. You have limited control as to where you can invest your money, and if you end up changing your job in the future, that can be a headache. One of the reasons people like the 401k so much is because they get this company match. But if you're not getting a company match, you might be better off just investing this money into your own personal accounts, because now you can use or access your money whenever you want. You have more control over your money, you have control over where you invest your money, and you can get your own investment tax breaks. Plus, when you invest your money in your 401k, you're limited because all your money goes into paper assets, stocks or bonds. But if you invest your money yourself, now you can go out and buy physical real estate as an investment. You can invest in your own business or really whatever you want. The challenge for a lot of people here is, one, you have to be disciplined enough to keep investing your money, and two, you need to know how to invest your money. But if you know how to invest your money and you're disciplined to invest your money, then you can beat your 401k returns. Regardless of what you decide to do, what you need to understand is that your 401k should never be your sole investment plan or your sole retirement plan. I mean, even Ted Banna, the founder of the 401k, says that the 401k has gone awry because so many people are treating their 401k as their sole investment plan. This is where money management and financial education comes in handy, because when you have the right financial education, you'll know how to use your money the right way and you'll know how to invest your money the right way. Fourth, you need to look at your 401k fees. NerdWallet did a study and they found that 92% of Americans didn't know what their 401k fees were. Wait. I'm paying for my 401k? Yes, you are. And money managers don't want you to know that. If you don't believe me, go log into your 401k account and look at the funds that your money is invested in. Now, take a look at what your expense ratio is. This expense ratio is how much money you're paying in fees each and every year. If your expense ratio says 1%, that means your 401k money managers are taking 1% of your assets every year where your money is invested in your 401k, and that's whether or not you make money. To put it in perspective, the average American is expected to pay around $140,000 in 401k fees over their lifetime of investing in the 401k, and you don't have to pay those fees to get the same returns. To understand how these fees work, you need to understand the difference between an actively managed fund and a passively managed fund. Lots of investment firms are going to try to sell you on the idea of an actively managed account because they have the best stock pickers who are going to find you the best stocks and buy and sell them to make sure you get the best return on your money. It sounds cool, but it comes at a price. A lot of times these actively managed funds will cost you somewhere between 1% to 2% of your assets every single year. On the flip side, a passively managed fund is managed by a computer, and it just manages the companies or investments that it makes based off a certain number of criteria. For example, if a fund invests in the top 500 companies in the stock market and one of the companies starts to tank, well, the computer is just going to kick out that one company and add in another company. And so because this is passive, it's a lot cheaper for you. These passively managed funds usually have an expense ratio of less than 0.75%, and a lot of times they're a whole lot less than than that. Now, you might be thinking, well, if I can get a better return with my actively managed funds, then why wouldn't I do that? You are 100% right. Except what we've seen throughout history is that over the long run, the lower fee passively managed fund almost always outperforms the expensive actively managed fund for the average investor. Psh, you don't know what you're talking about. A 2% fee is nothing. Let me show you how these fees can add up. Let's say you have two funds, Fund 1 and Fund 2, and Fund 1 has $100,000 in it, and this is a passively managed fund that charges you 0.07% a year in fees. Fund 2 is an actively managed fund, and this one also has $100,000 in it, and this fund will cost you 1.75% a year in fees. If you add in $10,000 into Fund 1 every year, and you add in $10,000 into Fund 2 every year, and you do this for the next 20 years, and both Fund 1 and Fund 2 both get you a 7% annual return on your money, well, Fund 1 will make you something like $775,000, while Fund 2 will only leave you with around $600,000 after paying for fees. That's an extra $175,000 you get to keep in your pocket, but now you're probably wondering, wait, but shouldn't your actively managed fund get you a better return if you're paying more? Well, if your actively managed fund got you an 8% annual return on your money, which is higher than your passive return, well, now you're still down $100,000 if you invested your money in the active fund. Your actively managed fund in this situation would need to get at least a 9% return on your money to just break even, which means they're going to have to beat the overall stock market for the long run in order for you to get a better return on your money. While that might sound easy to do, especially when you're paying these guys so much money, history has showed us that it isn't so easy. Like between the years of 2010 and 2019, passively managed funds outperformed actively managed funds, not 1 out of those 9 years or 2 years out of those 9 years, but all 9 of those 9 years. Now, don't get me wrong, there is a time and a place for actively managed funds, but if you want to get your money into the hands of the best investors out there, then you need more money to invest. And this brings me to the 5th thing you need to understand: asset allocation. Inside of your 401k, there are generally 3 places where you can invest your money. You can invest your money into equities, which are stocks. You can invest into bonds, which is debt. And you can invest your money in cash, which is just keeping your money in cash. When you are younger, you can afford to take more risk, so you can invest most, if not all, of your 401k money into equities or the stock market, because even if the stock market crashes, you have time on your side to make that up. As you get a little bit older, like you pass 45, now you want to think about being a little bit more conservative, and you might want to move some of your money out of stocks into bonds. You don't want to move all of your money into bonds, but bonds are there as kind of like that stable little cushion that give you smaller return. And then as you get a little bit older, and now you're seriously thinking about retirement, now you want to be moving more of your money into bonds and more of your money into cash or money market accounts, which is where your cash is just sitting there waiting for you to take it out. As you get older and closer to retirement, you're gonna want to allocate your assets in a way that protect your cash against stock market crashes like we've seen. And this kind of asset allocation is why it doesn't make any sense to trade your retirement accounts like your 401k, because if all of your money is in equities or the stock market and the stock market crashes, well, that means that you should be young enough to recover from a stock market crash. Now, while this is something you need to understand about your 401k, I cannot end this video without giving you some of my personal thoughts on investing and retirement planning. Personally, I'm not a huge fan of traditional retirement planning. I prefer to do something that I call lifestyle design. When I invest, I'm not just looking at, oh, how much is this asset going to be worth when I'm 60? I'm thinking, okay, how much money do I have to invest today? And how much money is this going to pay me next month and the month after that and the month after that? So I like to invest for this cash flow because now I get to decide, okay, do I want to reinvest this money back into my investments to get more cash flow tomorrow? Or do I want to use this money to live a better life today? And this would be through buying things like real estate as an investment, or in the stock market, buying things for dividends. And the reason why I don't like this traditional retirement planning so much is because what I've seen happen so many times is people treat it like, okay, I have to work at this job that I may or may not hate for 40 or 45 years. And then once I'm old enough, I'm gonna quit this job. That way I have this big lump sum of cash and so I can do nothing. I'm very fortunate where I love working. I plan on working as long as I possibly can, not just for the money, but because I really enjoy what I do. Well, when it comes to investing for your retirement, I think a lot of people have this misconception that the 401k is the only place where you can invest your money and let your money grow tax-free, and that's just not true. Real estate gives you that same advantage, and that's why wealthy people love buying real estate. When you buy real estate, not as a place to live in yourself, but as an investment, you can grow your money tax-free and get passive income at the same time. Real estate has these legal tax loopholes that let you buy a property for, let's say, $100,000 today, and let's say this property goes up in value in the future to $1 million. Well, now you can sell this property, get this $1 million in cash, go out and buy a bigger property, get more passive income, and now you don't have to pay a penny in taxes on this growth of your value from $100,000 to $1 million because of a tax loophole called the 1031 exchange. Like I said before, the 401k is just one investment vehicle, but it shouldn't be your only investment vehicle. My goal is for you to understand that there's more than one way to invest your money, and you might be able to build your wealth a whole lot faster if you invest your money in something else, which is what financial education is all about, because then you will understand the different ways you can invest your money, and you'll understand how to get better returns on your money. What happens anytime you see a bigger economic slowdown is credit dries up. It's harder to access cash. Investors become scared. People don't want to put their money out there. So now if you have cash, you can come in and take advantage of opportunities, which brings me to number 3, the first one that has to do with actually thriving through an economic slowdown.